the carrying amount of the asset. I'm just going to say carrying amount for now. Get the carrying amount of the asset 100 and credit profit on sale 100, right? From a group perspective, we look at that and say, wait a minute, we sold an asset of 150, right? First of all, now, because of what the sub has done, we still, from a group perspective, have an asset with a net amount of 50, because the sub has only derecognized 100. Are you with me? So we still need to derecognize the extra 50. So we credit 50 to that asset. Are you with me? Credit the asset 50, and then we say, look, the profit and sale that the sub recognized is overstated. It should only be 50, not 150. Therefore, the profit and sale needs to decrease. So we debit profit and sale 50. So our entry is debit profit and sale 50, credit land 50. Okay, think about it, just think about it. Don't worry, we're going to do some nice detailed examples on that. Okay, so if we've got a fair little understanding of this, let's take a little bit of a practical example. I'm going to put this up here, and I want you to read through it, then discuss it for a minute or two, and then we discuss it as a class. First of all, this is the intra-group transactions, right? We're going to move on to the fair value adjustment. I just want you to see that the two principles are similar. Okay. Does this make sense, ladies and gents? All right. This is intra-group transactions, guys. I'm sorry to say this. There was nothing in the test that was more complex than this. Okay. Same thing. All right. Now, the very same principle applies when we look at fair value adjustments and acquisition. It's just that now, we're not adjusting for the unrealized profit, we're adjusting for the difference in fair value. Okay. Does this make sense? Anything, what about it maybe doesn't make sense, or any questions that we may have? Okay, let me ask you a question. What would be the journal entry that we'd have to process here? What pro forma would we have to process as a result of this situation here? You tell me, tell the person close to you if you don't want to tell me. What is the pro forma that we processed here? Debit. What is the issue here? The issue is that the depreciation expense recognized by the sub is less than what it should be from a group perspective. But the sub is basing its depreciation on a carrying amount that is understated. Therefore, the sub recognizes a depreciation expense of 10, whereas from a group perspective, the depreciation expense should be 15. Make sense? All right. Therefore, we need to increase the depreciation expense by 5 in order to get it correct from a group perspective. So debit depreciation expense 5 and credit accumulated depreciation. Make sense? And what about the deferred tax? Okay, we can take the long route here and say we've adjusted an asset, therefore the carrying amount of the asset, tax base, blah, blah, blah. But the simple thing is to just say, look, what is happening with the profits? We've increased depreciation expense, that decreases profits, therefore the tax expense must come down. All right? By how much? 5 times 28%. If the tax rate is 28%. 5 times 28%, which is 1.4, we are going to credit our tax expense with that amount. And the contra goes to deferred tax SFT. All right. Now, what would the journal entries be here? Entry, yes, sir.
So you would debit the profit on sale of 50 and you would credit whatever the asset is of 50.
Perfect. So you debit the profit on sale by 50 and you credit the asset by 50. All right. So what is the issue here? The issue is that from a group perspective, the profit on sale is overstated. All right. Therefore, to get the profit on sale down, we have to debit profit on sale. And the credit goes to the asset. Why? From a group perspective, the asset that you should have de-recognized is an asset of 150. Whereas, now what has happened is that the sub has de-recognized an asset of 100. Make sense? So if you think about it, the asset is gone. The physical asset is gone. It's not in the group. Now, from a group perspective, say, look, we have an asset of 150. We've got a credit to that asset of 100, but we've got a net balance for an asset that doesn't exist of 50. Therefore, we need to remove that 50 as well. Therefore, our entry is debit profit on sale 50 and credit the asset 50. You still got, still making sense? All right. Okay, guys. Any questions at this point, guys? Yes, sir.
So it's not, it says the other way around where it's understated, right?
Yes.
It's for the both interest, would it just be the vice versa?
Vice versa. So the question from the gentleman is, what happens if, let's say, at acquisition, the asset has a carrying amount of 100, but the fair value is 80, right? But the asset is not impaired, right? So no adjustment is made by the sub. However, the fair value is 80. Then from a group perspective, the asset's cost should be 80. And that's what we should be depreciating. Or if the asset is sold, that's what we would minus from our selling price in order to get the profit on sale. Okay. So in that case, you will see perhaps the entries then, what you would have debited here might be credited, but nothing else is going to change. Make sense? Right. You guys are giving me hope, man. Honestly, guys, there isn't anything else to this. So if this makes sense and we can get through this example that we're going to do now, I assure you, I haven't got any tricks up my sleeves. Okay? This will be examined in AO5 and it will be examined in the final exam. It's not going to look different because there is only one principle, that of the group difference. Alright, so what we hope to achieve by the end of the class is that you should be able to answer these questions for yourself. Okay. I hope that by now, maybe some of these questions we can answer already, but by the end of the class, we need to be able to answer all of these questions with confidence. If we achieve that, then we will have achieved what we need to achieve for today. So let's then go to our example. Our example is broken up into two parts. Part A is basically asking for the adjustments that you need to make at the acquisition date, right? So it's saying this is the acquisition date, 28 February 2020. Give me the adjustments at that date. And then part B of the example is saying now we are no longer consolidating at 28 February 2020, but 1 year later at 28 February 2021. Give me everything as at that date. What that means now is that there will be the adjustments at acquisition, of course, but there will also be the effects on the subsequent measurement of those assets. All right. So, part A. Springbok Limited acquired 80% of the Class A shares of Libbok Limited on 28 February 2020. Each Class A shares entitled the shareholder to one voting right. Springbok Limited and Libbok have a 28 February year. Okay, just lets us know that we have control here and we have 80% interest in the equity. Okay. The consideration is made up as follows: 200,000 paid in cash. When we talk about consideration, all we're worried about is what is the fair value of that element of consideration. So, 200,000 paid at the acquisition date, the fair value is 200,000. 200,000 payable a year later does not have a fair value of 200,000. In this case, we've given it to you, it's 170. In a real exam, you might have to calculate it. Okay. A machine with a carrying amount of 50,000 and a fair value of 70,000. Okay, that fair value of 70,000 is what we are going to include in the consideration. And then lastly, 250 of its own shares, and each has a par value of 100 and a market price of 500. The market price is what we are going to use because we are concerned about what is the fair value of those shares, not what is the par value of those shares. Okay, all of those elements put together are going to give us the consideration. Okay, we are then told that the fair value of the non-controlling interest was determined to be 180,000 on 28 February 2020. Most times, if you see that information, it almost implies that the NCI will be measured at fair value. However, don't assume that. Please check the additional information. Make sure that the additional information does state that. In this case, the additional information does state that the NCI was measured at fair value. Okay. All right. We're then told that all of the assets or net assets of Libbok were fairly valued at acquisition, with the exception of the following. Okay. The land had a carrying value of 85,000, but a fair value of 120,000. We know that IFRS 3 will require that we adjust that balance of land from 85,000 to 120. So that's plus 35. We'll have to debit land by 35. Happy? Building 2, carrying amount of 90,000, fair value of 160,000. Again, we are going to have to adjust that building 2 up by 70,000. Debit buildings, 70,000. The machinery has a carrying amount of 250 and a fair value of 330. Again, we are going to have to debit that machinery by 80,000. Okay. All right, we happy so far? In the additional information on the assets and liabilities is that land consists of a piece of land that was acquired by Libbok at a cost of 85,000 on 1st July 2018. The land is accounted for on the cost model. This information here doesn't really tell us much. All it's there for really is so that you don't confuse yourself in the textbook. They have this, before they get onto consolidation fair value adjustments, they have an example there where the adjustment is made in the books of the subsidiary. They have an example there, they talk about revaluations made in the book of the subsidiary. Okay. So what they're saying is, let's say you had land at a cost of 100 and a fair value of 120. Immediately before consolidation, the sub revalues it to 120. You no longer have a difference at acquisition, and therefore you don't have any pro forma adjustments. Okay. So that's why this information is there, to make sure that you don't confuse the situation with that situation. All right. So the sub did not adjust this land in its own books. Building 2, an owner-occupied property which the BOP carries on the cost model. The BOP acquired the building on 1st March 2015 at a cost of 180. The building has an estimated useful life of 4 years and a nil residual value. Okay. What's the important information here? The remaining useful life of 4 years. Because we know that we are going to be depreciating a different balance from a group perspective to the balance that is depreciated by the sub, right? The sub is going to depreciate, it's going to depreciate, building 2, sorry, what was it again? It's going to depreciate 90,000 over 4 years. From a group perspective, we should be depreciating by 60,000 over. Okay, does the residual value information matter? Does it change anything? No, not for our adjustments. Okay, because if the residual value is 10,000, the sub is going to say 90,000 minus 10,000 divided by 4. The group is going to say 160,000 minus 10,000 divided by 4. Okay, so the existence of a residual value does not affect our group adjustment. Our group adjustment is solely based on the group difference that arose at acquisition. That group difference is the difference between 90,000 and 160, so it's 70,000. So instead of saying 90,000 divided by 4 equals this amount, 160,000 divided by 4 equals this amount, and the difference between those two is the adjustment, you could simply take the 70,000 difference between 160 and 90 and divide that by 4. You'll get the exact same answer. Yes, ma'am? Is that? No, the residual value has no effect. Yeah, so that's what I'm trying to get across, guys. Whether the asset has a residual value or not does not affect our group adjustment. Because the residual value applies both to the group perspective and the sub perspective. There's no difference there. The difference only arises as a result of the difference between the fair value at acquisition and the carrying amount of that asset in the books of the sub at acquisition. Now, if you look at machinery, okay, the same thing, we're concerned with what is the remaining useful life. Okay, then we are told that the equity of the sub at acquisition was basically 400,000 made up of share capital of 100,000 and retained earnings of 300,000. Right. So that's what the sub has in its own books. At acquisition, because of those fair value differences, we are going to have to adjust that equity. We are going to have to adjust those net assets in order to get the fair value of the net assets at acquisition. All right. We then told that the corporate tax rate of 28% and capital gains inclusion rates of 80% are always applied. Okay. What is this going to relate to? What is going to be affected by this information here? Do we have any assets that are non-depreciable assets? Land. All right. Okay. Because land is a non-depreciable asset, it cannot be recovered through sale, through use. It can only be recovered through sale. All right. Therefore, the tax consequences of land will always be the tax consequences of sale. Whereas an asset that is a depreciable asset is an asset that can be recovered through use. Therefore, the tax consequences of that asset would be the tax consequences of use. What do we mean by that? The machinery operates, produces inventory, you sell that inventory, sales revenue included in gross income. Tax at 28%. Are you with me? Whereas the land, it doesn't it doesn't get consumed as you use it. It's non-depreciable, so what happens? You can only recover it through selling the land. When you sell the land, it first goes into a pool of capital gains, then only 80% of that capital gain is included in gross income. All right? And that's why it will be taxed at the CGT rate. All right. Are we comfortable so far? All right. Now, because you guys are super diligent students, you guys have already done this at home, right? Okay. So what I want you to do, I just want you to do a brief comparison of your solutions amongst each other. Okay? And those of you who want imaginary solutions, you do the talking. Right, just 4 minutes, let's do that, and then we'll look at the solution together. What balance of goodwill did we get? Goodwill is a balancing figure. If you got that right, you probably got everything else right. So, what balance of goodwill did we get? Anyone want to? As I pick someone. I need people wearing hats. All right, did we get a balance of 209,840?
Yes.
Okay. Right? Perfect. If we didn't, it's not the end of the world. Maybe we just made one mistake. You know how these things work. Okay, so here is our suggested solution. All right, does it make sense, ladies and gents? Okay, so in our analysis of equity and acquisition, what we are going to have there is we are going to have our equity as per the sum, and then we are going to adjust that equity, or those net assets of 400 will be adjusted by our fair value adjustments and acquisition. Okay, so what are our fair value adjustments and acquisition? You can do it one of two ways. You can show these actual adjustments here in the AOE, or you can do it the way the textbook does it, and you do them in a separate calculation, and you take the net adjustment to the AOE. Happy? Okay, so we see our adjustments there for land. Land must be adjusted up by 35,000 to get it to the fair value of 120. As a result of that adjustment, the deferred tax liability related to the land is also going to go up. Because the land is a non-depreciable asset, that deferred tax is going to be at the capital gains rate, meaning that it's at 80% times 28%. When we look at building 2 needs to be adjusted up by 70,000. Because we've adjusted the carrying amount of the building up, the related deferred tax liability also goes up. This asset is recovered from use, therefore deferred tax is at 28%. The same thing for the machinery, it's adjusted up by 80,000. The machinery is also recovered from use, therefore the deferred tax is at 28%. Okay. Happy? This is an AO5. Full marks, huh? Guys, please. What if we journalize this now? Because the second required here says, okay, prepare the AOE, right? You've got all the adjustments. Now it wants you to put them in the form of journal entries. Make sense? So first thing we do is we process our adjustment to adjust the carrying amounts to their fair value for those assets that are not sitting at fair value. And we take the net amount to the equity at acquisition account. The equity at acquisition account acts as the contra account for all our fair value adjustments. At the same time, the equity at acquisition account is going to be eliminated as part of our elimination entry. So in essence, the equity at acquisition account is something I would call sort of a suspense account. A suspense account is an account that you take an adjustment to and then you take it out again. Are you guys with me? So in our group books, there is no equity at acquisition account. It doesn't exist at the end of the day. Are you guys with me? Because we created and eliminated at the same point in time at acquisition. You see here we have a net credit to equity acquisition of 135,160. And then as part of this journal entry, we debit equity acquisition by 135,160. So therefore, there is no balance of equity and acquisition in our group trial balance. Right. So this would be then our elimination entry. Okay. We eliminate the equity of the subsidiary at acquisition. So all of these equity accounts, including that equity at acquisition account. We eliminate the investment in Libok, in the subsidiary. We recognize the non-controlling interest. And of course, the net amount is either a goodwill asset or a bargain purchase gain. Yes, sir.
Let's say land was understated.
Yes.
Then you would have debited equity at acquisition, isn't it?
Okay. So the question from the gentleman in front is, let's say the land, instead of the land being overstated, instead of the land being understated, i.e., instead of the fair value of the land being greater than the carrying amount, as in this case, what if the fair value of the land was less than the carrying amount? Is that the question?
Yes.
All right. So let's imagine we say the land has a carrying amount of 85, like this example, but let's imagine that its fair value was 70,000. All right. In which case then, the fair value of the land is 15,000 less than its carrying amount. Okay. Again, IFRS 3 says that land must be recognized for the first time by the group at its fair value. Therefore, we need to adjust that land down from 85 to 70. You guys with me? That means we need to credit land with 15. All right? Because we're decreasing the carrying amount of the asset, it's going to decrease the related deferred tax liability. Deferred tax liability is carrying amount minus tax paid. Carrying amount is less, temporary difference is less, deferred tax liability is less. All right. So the deferred tax liability in that case is going to be debited. All right. Then the net amount is a net debit that goes to equity at acquisition.
Yes, so then, that, for example, that 27,160 will be negative in that case.
Yeah, in that case, that would be a debit to equity at acquisition. This will still remain a credit as it is here, right? But if you say, if the situation here was that the fair value of the land was 70,000, we'll end up with a debit to equity acquisition in this particular entry. Okay. Are we still comfortable? All right. Okay. I've got some questions for you. I was very tempted in AO4 to ask this question, but I felt like you guys might torch my car or something. So I'm going to ask it maybe later on in the year. Can you explain to the person next to you each debit and credit here? I.e. explain why you debited it and why you're debiting by that amount, or why you're crediting it and why you're crediting by that amount. So this would be a question for about 1, 2, 3, 4, 5, 10 marks. Okay. So I'll give you 2 minutes. Explain to the person next to you each debit and credit. If you don't have anyone next to you, you can come to the front and explain to me. Okay. Let's start with the shakeout. Why we're eliminating the subsidiary share capital? What does the share capital represent in a set of financial statements? It represents the holdings of that entity's equity holders, right? Okay. Who are the equity holders of the group? It's not the shareholders of the sub. It's the shareholders of the parent. Are you guys with me? Therefore, the only share capital we want to see in the group financial statements is the share capital of the parent. Because the share capital of the ultimate holder is those of the parent. Why are we eliminating the retained earnings at acquisition? Again, we ask ourselves, what does retained earnings represent in the set of financial statements? It tells the user, this is what the profits or losses that were earned by this particular entity in the past. Okay, now we're looking at a group. These profits were earned before the sub became part of the group. Therefore, they do not represent profits that were earned by the group. Make sense? They're pre-acquisition profits, and that's why we eliminate. Okay. Now, if we go to the investment in Libor, why do we eliminate that investment? All right? When we look at these entities as separate legal entities, we can say this one has an investment in that one. Once we bring them together into one economic entity, we can't have an investment in ourselves. Make sense? Secondly, what does that investment represent in the books of the parent? That investment represents the parent's interest in the net assets of the subsidiary, right? But if we consolidate, we've already brought those net assets here. Therefore, if we have an investment in subsidiary and we have those actual net assets here, we are double counting the same interest in the net assets. Make sense? All right. Then my phone rings. Sometimes I think these people like put bugs in your phone. When you touch it, it always rings or something. Get a message. All right. The non-controlling interest. Why are we recognizing the non-controlling interest? We've brought onto board 100% of the net assets of the subsidiary. However, the interest of the parent is only 80%. If we don't recognize an NCI, we will reflect the entire 100% as belonging to the parent. By recognizing the NCI equity account, we are saying that there is another shareholder which has an interest in the subsidiary's equity. All right. Make sense? Okay, perfect. Cool. Now, I want you to just spend a minute, in the interest of time, just a minute reflecting on these questions. You don't have to discuss them, just read them, think about them. Basically, what we're asking ourselves is, have we achieved the objectives from part A before we move on to part B? Yes, sir.
So, I just want to find out, sir, how would you explain the equity and acquisition fund? And you discussed.
Like I said, I hate that account because it's a suspense account. The actual thing that you're doing is adjusting the assets. Are you with me? So this is adjusting the assets and the deferred tax, and then creating the suspense account that you eliminated it. It's a nothing account. It doesn't have any impact. The real thing that you've done there is this. You've adjusted the land up by 35,000. Why? Because from a group perspective, the cost of that land is a fair value acquisition, right? Therefore, the group wants to present that land at 120,000, not 85,000. Okay, the same thing for the building. From a group perspective, the fair value of the building was 160. That's the cost of that building the first time it was recognized by the group. However, in the South book, it's sitting at 90,000. Therefore, we need to adjust it up by 70,000. So that's how you explain that. Then, any deferred tax adjustments you would explain from the perspective that any increase in the carrying amount of an asset without a corresponding movement in the tax base will increase the temporary difference and therefore increase the deferred tax liability. Right. see a statement of financial position with equity acquisition, minus 5. If I see another pro forma with bank, minus 100. What do we adjust for, guys? We only adjust for measurement differences between the group and the sub, or the group and the parent. Are you guys with me? 100 Rand cash is 100 Rand cash. We don't say the sub valued the 100 Rand. No. Are you guys with me? You will never, ever, ever have an adjustment to bank. So if you ever write a pro forma and you think about writing bank, don't. Okay. You already know that something's gone wrong with it. Okay. Now let's look at part B. So part B now is saying that we are consolidating now at 28 February 2021. So everything that we did when we were consolidating at 28 February 2020, i.e. at acquisition, we need to do again. But now we need to also process the pro forma adjustments relating to the since acquisition period. Okay. Therefore, if there are any group differences that arise there, we need to adjust for those group differences. Remember we said that with the depreciable assets, we are going to have a group difference in terms of depreciation. If any of those assets is sold out, we are going to have a group difference in respect of the profit on sale. If any of those assets is impaired, we are going to have a group difference in terms of the impairment expense. All right? Does that make sense? Think about it, impairment expense. What's the carrying amount that you are comparing to the recoverable amount? At a group level, the subs books, what's the carrying amount that you're comparing to the recoverable amount? You're going to end up with two different amounts for impairment expense. And you need to adjust to the amount that the group needs. If we had land that was revalued, again, the same issue, the revaluation gain would be different from the group perspective and from the sub perspective. And you'd have to process an adjustment there. All right. So, statement of comprehensive income of, so this is a continuation first from part A. So all the information in part A also applies here. Now, the statement of comprehensive income of Libbok Limited for the year ended 28 February 2021 reflected a net profit of 200,000. Included in this net profit is a profit on sale of 40,000 in respect of the land. Okay, so that's what was recognized by the sub. Without any further information, you can really work out if they have a profit on sale of 40,000 and if they had a carrying amount of 80,000, it must mean they must have sold it for 40,000 above the carrying amount. So the selling price is 125. We don't need this information, but it's there. You can work it out yourself. But it's been given here, okay, the proceeds were 125,000. Also included in the net profit is an impairment loss of 7,500 in respect of building 2. Okay, the impairment loss was determined based on the recoverable amount of the building, which was 60,000 on 28 February 2021. Okay, so you need to think about what is the impairment loss that was recognized by the sub, 7.5. What should the impairment loss be from a group perspective? And then we need to adjust that impairment loss to get it correct from a group perspective. All right, so thinking about this, guys, based on the information that we have here and the information that is in part A, we know these are the adjustments we're going to have to make. Let's start with the land. Is it depreciated? No, there's no depreciation adjustment for land. However, the land is sold out. There's going to have to be an adjustment for the profit on sale of the land. Okay, that's the first one. Then if we look at the machinery, that machinery is going to be depreciated post-acquisition. We said that the useful life of the machine, I think, was 5 years. Therefore, we are going to have a depreciation difference over those 5 years. Okay, we'll need to adjust for that depreciation difference for the machine. For the building is also depreciated. It's going to be depreciated, I think it's said over 4 years. We're going to have a depreciation adjustment in respect of the building. And then we're also going to have an impairment loss adjustment in terms of the building. Okay. Then, that is it, right? Those are assets. Okay. So, what adjustments did you guys get when you were doing this at home? Let's start with the land. Let's start with the land. Subs books, carrying amount of 85, sold for 125, we recognize a profit on sale of 40. From a group perspective, the carrying amount is 120, it was sold for 125, profit on sale should be 5. So what adjustment do we need to process? We need to debit profit on sale by 35, right? And the contra entry goes to land. Make sense? Okay. Why am I telling you the answers, by the way? You guys did this at home. You should be answering me, you know. You know when you sometimes stand in front of the class and you ask, okay guys, anyone, give me an answer, and then everybody looks at each other and they keep quiet. Then it's like a truck going uphill. It just does. You can feel the momentum. It's just going and it's going and it's going. Okay. Guys, depreciation adjustment here. What's it going to be? We're told that building 2 has a useful life of 4 years. We know that from the subs perspective, we're depreciating 90,000 over 4 years. From a group perspective, we're depreciating 160,000 over 4 years. Okay. What is the difference that we're going to have there? Say again? 17.5, yes. Because from the subs perspective, we've got depreciation expense of 22,500. However, from a group perspective, the depreciation expense should be 40,000, right? Therefore, the depreciation expense is understated by 17,500. And we need to debit, increase depreciation expense. Debit it by 17.5 and credit accumulated depreciation. Now, the same thing for the machinery. The machinery is depreciated over a useful life of 5 years. That's the remaining useful life. From the subs perspective, the machinery should have a depreciation of 50,000 per year. From a group perspective, the depreciation should be, someone do the maths for me, 66,000 Rand per year. Okay. Therefore, from a group perspective, the depreciation expense that's been recognized by the sub is understated by 16,000. Therefore, debit depreciation expense 16,000, credit accumulated depreciation 16,000. Yes, it is. It is. But I'm just skipping it for now. We'll come back to it. Is it making sense, ladies and gents? All right. Now, let's go back now to the impairment of building 2. All right, so we have building 2. It's depreciated for the 2021 financial year, and then at the end of the 2021 financial year, an impairment test is performed, and that building is impaired. Now, when that impairment is being done, the sub is going to say, I have a building, 90,000, with a carrying amount of 90,000 minus 22,500. What's that carrying amount? 90,000 minus 22,500 is a carrying amount of 67,500. 67,500. Okay. Now, from the perspective of the group, the carrying amount of that building is cost of 160 minus depreciation of 40,000 is 120,000. Happy? If the recoverable amount of that building is 60,000, from a group perspective, the impairment loss should be 120 minus 60 equals 60,000. However, the impairment loss recognized by the subsidiary is how much? 7,500. So it means that the impairment loss is understated by 52,500. Therefore, the adjustment that needs to be processed in order to correct us from a group perspective is to increase impairment loss. So debit impairment loss 52,500 and credit accumulated impairment 52,500. Making sense? Right. Okay. Now, when you talk about the deferred tax, very simple, guys. What's happening to profit and loss? If profit and loss, let's say the impairment loss is increasing by 52,500. That means profit and loss is decreasing by 52,500. That means that taxable income is decreasing by 52,500. Therefore, the tax expense must decrease by 52,500 times 28%. Okay. Similar thing, if the depreciation expense needs to be adjusted up by 17,500, that means profit and loss is decreasing by 17,500, and therefore the tax expense must also go down by 17,500 times 28%. All right. Okay. So let's quickly go back to the required. So what's the pro forma journal entries required? Narrative statement. Okay. What's the AOE for Limbok Limited for the year ended 28 February 2021? That AOE will always include the add acquisition section. All right. You have the add acquisition section, and then you have your since acquisition section. The add acquisition section doesn't change. It's a photograph. Whatever it was at acquisition, no matter what date you're consolidating on, the at acquisition portion of the AOE remains the same. Okay, which is why it's exactly as it was when we were doing part A. So this is not going to be the focus of part B. You already know what this is. In order for us to get that since acquisition section of the AOE correct, we need to take the profit of 200,000 and we need to adjust that profit by all the group adjustments that need to be made in respect of that profit, i.e. the adjustments that are made to incomes and expenses to get them correct from a group perspective. So before we can do that, we need to work out what those adjustments are going to be. We have already discussed these adjustments. I'll come back to them if you want, but we've already discussed them. So let's go straight to the AOE. So our since acquisition section of the AOE starts with a profit and loss of 20,000, and then we adjust it for our group adjustments. The first group adjustment is for the understatement of that depreciation expense, right? And that is going to decrease the profit by 17,500. Because it decreases the profit by 17,500, it decreases the tax expense. Tax expense is an expense. When it decreases, it's going to be a credit to profit and loss. Are you guys with me? Therefore, it's a plus to profit and loss when an expense decreases. Then we have the adjustment for the depreciation of the machinery and the related tax effect. Then we have the adjustment in respect of the profit on sale, which was overstated. And then we have the related deferred tax adjustment. And then we have the adjustment in respect of the understated impairment loss and the related deferred tax adjustment. Okay, let's take a minute to digest. Okay, yes sir.
So after the impairment loss, how come you use the group reference there?
the
Impairment loss.
okay, we're gonna go back. All right. Okay. All right, guys, you will note here that the way I've done these calculations here is we are looking only at the group difference, right? Okay, there's two ways to do the calculations. You can either look at the group difference, that's the simplest way, or you can say, look, what is recorded by the sub, what should be recorded by the group, and that will give you the same difference. You guys with me? Okay. So let's go back to those so you can see what I mean. Let's take the depreciation and build into, right? We can say, look, the depreciation as per the book is 90 divided by 4, 22,500, right? Whereas the depreciation that should be recognized by the group should be 160 divided by 4, which is 40,000. Yeah? Therefore, the difference between these two is 17,500. And we need to adjust the depreciation expense up by 17,500. Okay. What is giving rise to that difference in depreciation? That difference in the depreciation expense between the sub and the group arises only as a reason of there being a different carrying amount from a group perspective to the carrying amount at the sub's perspective. Are you guys with me? Okay. The 70,000 difference here is what gives rise to the difference in the depreciation expense. So if we want to simplify, we can simply say 70,000 being that we know is responsible for the difference, and if that 70,000, that part of the carrying amount of the asset is going to be depreciated over 4 years, we can say 70,000 divided by 4, this is how much of a difference we are going to have in the depreciation expense each year. The same thing when you go to the machinery, we can either do it like this, what is the depreciation recognized by the sub? What should it be from a group perspective? What's the difference? It's 16,000. Or we can say, what gives rise to that difference? Well, it's a result of there being an 80,000 rand difference between the carrying amount at a group perspective and the carrying amount in the books of the sub. Therefore, if that asset is depreciated over 5 years, that difference of 80,000 will also reverse over the 5 years. Therefore, 80,000 divided by 5 is going to tell us what the depreciation per year is in the depreciation expense. Okay. Now, I'll come back to you now. I do not mind which approach you use, right? I like this approach, all right? This is the approach that I like to use if I'm explaining it to somebody. But if I was writing a test, I tend to use this one, right? It's just a quicker calculation, right? But use the approach that you are most comfortable. This one, super clear for a marker. Even if you make a mistake along the way, you'll probably pick up most of the marks. This one, if you just do that, and by mistake, you write 7,000 instead of 70,000, you get 0 out of 3. Are you with me? Okay. Yes, sir.
So, I understand that, but there's some calculation, they say payment loss.
Yes. We're getting there. Okay. Getting there. So we're happy with this, right? Okay, cool. So, what is, remember we're saying here that the difference, that 70,000 difference, attaches to the asset. As that asset becomes realized, that difference becomes realized. The asset gets realized through depreciation, that difference will get realized through depreciation. If the asset is getting realized through some other form, let's say a sale or even an impairment, then that difference gets realized through the impairment as well. So if we think about it, at the beginning of the year we had a difference of 70,000, and then 17,500 of that difference reversed during the year through the difference in depreciation. Are you happy? So by the end of the year, the difference that we have is 52,500. Okay, 70,000 minus 17,500. Another way you can do that is you can say, look, the carrying amount from a group perspective is 160 minus 40, which is 120. The carrying amount in the sub perspective is 90 minus 22.5, which is 67.5. The difference between 120 and the 67.5 is 52,500. Okay. Yes, sir?
So are you so you say
Yeah.
you repaying it in both books. You're repaying in both books, and that's how you get that 52,000.
What I'm saying is that the issue here is the group difference, right? That group difference is the one that's giving rise to the differences in depreciation and the difference in this case in the impairment loss, right? So we need to ask ourselves, what is the group difference at that point in time? So as per the end of the year, the group difference is no longer 70,000 because 1/4 of that 70,000 has already been realized. The group difference as at the end of the year for this particular building is 52,500. Now that 52,500 you can determine one of two ways. Ask yourself, what is the carrying amount of the building from a group perspective? 120,000. What is the carrying amount of the building in the books of the sub? It is 67,500, right? What's the difference between 120 and 67,500? 52,500. You happy? So that's the group difference, right? At that point in time. Now the other way you can work out the group difference, which is a bit of a shortcut, is to say, look, the group difference was 70,000. This group difference will be realized over 4 years. Part of it was realized through depreciation, 17,500 of it. Therefore, the remaining group difference is 70,000 minus 17,500. Where is it? It's 70,000 minus. So that's where that calculation comes from. But like I said earlier, from a clarity perspective, it's better to do it like this. Where's that? Let me leave that slide there, guys. I don't want to talk myself into a whirlpool. So maybe reading it clearer. Consolidating at 28 February 2022 now, right? Well, the only thing is that the impairment loss will be now sitting in retained earnings. So instead of debiting impairment loss, we debit retained earnings. And then, accumulated impairment. Yeah. Accumulated impairment. Okay. So, I mean, that's a valuable question. Okay, the question, guys, is what if we were now consolidating at 28 February 2022? Would our entry still be debit impairment loss 52,500 and credit accumulated impairment? No, our entry now would be debit retained earnings and credit accumulated impairment. All right. Now let's follow on now. From the date of that impairment, are we going to still have an adjustment in respect of depreciation? The question is, do we have a difference in the depreciation recognized by the sub versus the depreciation recognized by the parent? Remember at acquisition we had a difference of 70,000 in the carrying amounts. That resulted in a difference in the depreciation expense of 17,500, and then we had a difference in the impairment loss of 52,500, right, to get us to a recoverable amount of 60,000. Now, that 60,000 is the carrying amount in the books of the sub. It is also the carrying amount in the books of the group. Does it make sense? Because the asset has now been paid to 60,000. It's 60,000. The recoverable amount is the recoverable amount. So going forward, there's no difference in the carrying amount of that asset from a group perspective and a sub perspective, and there will be no more depreciation adjustments. The same thing would happen if we had land and we revalued it. After that land is revalued, there is no group difference anymore because the fair value to be revalued to is that fair value. The group difference will have reversed entirely. Okay. Now I want to do a picture of this thing. I'm going to use not this one here. I want to use, because I can see we're having trouble with this issue of the group difference reversing over time. Okay. Let's use the machinery. At acquisition, the group difference is 80,000. Depreciating here at 330, here we're depreciating 250. 50,000 versus 66,000. Okay. A year after acquisition, that group difference is no longer 80,000. That 80,000 has been depreciated by 16,000. Are you guys with me? It's 64,000. 2 years later, it's 48,000. 3 years later, 32,000. 5 years later, 16,000. Or 4 years later, 16,000. 5 years later, zilch. Okay. As the asset, the underlying asset is itself getting realized, the group difference also is getting realized. So if we go back now to the building 2, at acquisition the group difference was 70,000. A year later the group difference is 52,500. And that group difference is the one's going to give rise to any adjustment that we process. I.e., if the asset is adjusted to an impairment, or the asset is sold out, or the asset is revalued, that entire 52,500 reverses on that day. Make sense? All right. Okay. Right, so that is our pro forma. This is our AOE. Part of the required, let me be quick, asks us for the pro forma journal entries for the NCI's profits. Okay, for that, we just need to look at the since acquisition section of the AOE. Okay, what is the correct adjusted profit? What's the NCI share of that? Okay, it's a profit. Therefore, when we allocate to the NCI, we credit NCI SFP account, and the contract goes to debit NCI P&L. Okay, make sense? Now, if we're asked to give the balance of the NCI, and required for a question, you could get a question that says, 40 marks, what is the balance of the NCI? What that means, you have to do the at acquisition interest, or determine what the NCI is at acquisition. If it's not at fair value, you have to do that at acquisition section. Right? In order to work out what's the fair value of the net assets, and then the NCI is 20% of that. Then you need to do a post-acquisition or since-acquisition section of the NCI to adjust the profits and get them correct, and allocate to the NCI those corrected profits. The NCI balance at any point in time is the NCI's balance at acquisition plus its share of the post-acquisition profits. So in this case, our balance of the NCI would be the 180,000 at acquisition plus its share of the post-acquisition profit, which is 22,184. And that gives us an NCI balance of 208, total 184. Okay, guys, I'm almost done. That is very important because that is an actual required that you are likely to see. And if you look at past papers that you will have seen, where the required simply says, what is the balance of the NCI at this point in time? And from that, you must know that you are required to work out the NCI at acquisition and also work out what is the NCI share of the adjusted profits, which means those profits will have to be adjusted for any fair value adjustments issues and any intergroup transactions issues in order to get those profits correct from the group perspective. Right. So I'll leave this up there for a minute. And as I do that, I'll also put on the appendix.